Cost of capital is a critical concept when it comes to making investment decisions. It is the rate of return that a company must earn in order for its shareholders to be willing to invest in it. Companies must take into consideration their cost of capital when making decisions about projects, investments, and acquisitions. What is cost of capital? Cost of capital is an important concept when it comes to analyzing the profitability of a business. It measures the cost of funds that a company has to pay for raising capital from investors or lenders. The cost of capital is determined by the risk associated with raising funds, and it has to be taken into consideration when making investment decisions. It is an essential tool for managers who need to determine the best way to utilize their limited resources and maximize their returns on investments. The risk the investor or lender has to take can affect the cost. The higher the risk, the higher the cost will be. The term cost of capital has been used by analysts and investors, but it is always an evaluation of whether a projected decision can be justified by its cost. Investors may also have used the term to refer to an evaluation of an investment's potential return in relation to its cost and its risks. The cost of capital is different for different types of businesses. A company's cost of capital can be calculated by multiplying its current book value per share times the required return on equity, which is the average rate of return that investors require as compensation for their risk as measured by a viable alternative investment with similar risk and reward. The cost of raising capital can be calculated as a percentage of current assets or as an annualized percentage. The value at which an asset is bought and sold on the market, where buying low and selling high is the strategies used by investors to maximize returns on their investments. Importance of cost of capital. The cost of capital is an important factor in any financial decision and investment. It helps to determine the rate of return a company needs to make on its investments in order to cover the cost of borrowing or making investments. By understanding the cost of capital, businesses can make more informed decisions about how much money to borrow and how much to invest in different projects. This knowledge can then be used to decide which projects are worth investing in and which ones should be avoided. An investment will result in a net benefit to the company's balance sheets if the return is higher than the cost of capital. On the other hand, an investment with returns that are lower than or equal to the cost of capital suggests that the money is not being used prudently. The majority of companies try to develop and grow. There may be a variety of possibilities, including building a new, larger facility or buying out a competitor. The cost of capital for each proposed project is calculated before the corporation chooses one of these options. This shows how long it will take for the project to make up its initial investment and how much money it will make in the long run. Of course, these projections are only estimates. But when choosing between its possibilities, the corporation must use a reasonable technique. Understanding cost of capital. Cost of capital is an important concept in finance that can help businesses assess how much they need to invest in order to achieve a desired return. It is also used to determine the cost of borrowing money and the return on investments. We will take a look at some common methods used by businesses to calculate their cost of capital and the associated risks. Here's an overview of what cost of capital is. The amount that an investor is willing to pay for a stream of future returns, less the amount they expect to receive in those same future returns. For example, if an investor expects a 10% return on their investment in 1 year, then they are willing to pay $100 for each dollar they invest. The cost of capital will also depend on whether or not there is risk associated with your investments. It can be calculated as the rate of return minus the risk-free rate, the inverse yield. There are 3 different methods that businesses calculate their cost of capital. They can use the Capital Asset Pricing Model, CAPM, the Gordon Growth Model, and the risk-free rate method. To understand what this means, let's say you are considering investing in a business that has an ROIC of 10%. The cost of capital for this company is determined by finding out what rate they must be able to earn on their investment before it becomes too risky for an investor to be able to invest in them. 10% to 5% equals 5%. The company must earn at least as much as 5% before it can be considered to have a good chance of being able to continue in business. The cost of capital is the rate that investors demand, minus the risk-free rate. This will tell you how much money a company must generate on average each year before they are considered safe enough for investors to invest their money in them. Capital Asset Pricing Model, CAPM. The capital asset pricing model is a mathematical model that determines the return on investment based on how risky the investment is. The cost of capital for a company is equal to the risk-free rate plus or minus what an investor can expect to earn from investing in the company. To calculate this, you start by determining what type of return investors are willing to accept and then find out what their expected rates of return are using different types of investments. Risk-free rate expected return equals capital's cost of capital. A break-even analysis is a method for determining the point in time when a company has earned enough revenue to cover the total costs of production during a given time period. This result is then subtracted from total sales to find out what it would take for sales to be equal to total costs. The break-even calculation for this company in 2009 was $4,813,000, which means that if all units sold had been produced at this cost level, the company would have earned $4.813 million in revenue and still had a $4,813,000 negative cash flow. The calculation is straightforward. We need to find the total cost of production that's needed for sales to be equal to total costs. That happens by subtracting the contribution margin from total sales. $12 million equals $4,813,000 to $4,626,800. Break-even analysis can help a company determine when they will be profitable or not at a certain level of output and specified price point. Cost of capital versus discount rate. When analyzing the cost of capital, understanding the difference between the cost of capital and discount rate is essential. Both terms refer to the cost of acquiring a certain asset or financing a particular venture, but they have different implications. The cost of capital takes into account both the debt and equity costs, while the discount rate looks at only one side, usually the debt side. The discount rate is often used to determine if an investment is a good idea or not. It helps decision-makers compare the present value of two possible future scenarios, one with the project happening and one without. When considering debt financing, the interest rate applied to a loan would be referred to as a discount rate. In contrast, costs of capital take into account all sources of costs associated with the project under consideration, both debt and equity, while disregarding the time value of money. These costs include both interest rates and fees related to accessing financing. They are calculated using similar formulas but yield different answers than those derived from discount rates. The terms cost of capital and discount rate are frequently used interchangeably since they are somewhat similar. The finance department of a corporation frequently determines the cost of capital and uses the results to help management set a discount rate or hurdle rate that must be exceeded to justify an investment. Thank you for watching.